Alrighty, well, we actually have a decent amount of our registrations who have joined already. So I'm going to go ahead and start my spiel so that we can get started and have plenty of time to answer any questions you guys may have. So thank you for joining us for today's webinar, Best Accounting Practices for Your Small Business with Todd Davis of MHCPA, my apologies. Just a few quick housekeeping things before we get started. You are welcome to ask questions. We just ask that you submit those via the chat box there in your Zoom toolbar, and we will address them either throughout the presentation or once the presentation is over before we close out the webinar. You will also receive a follow-up email that will probably go out tomorrow morning based on when the Zoom is done processing, but you will get a link to the recording and then some links to our website, calendar, and things like that, so you can join us for any additional sessions. So I will hand it over to Todd and we can get started.
Okay, thank you, Jordan. So good afternoon, everyone. My name is Todd Davis. I have worked 30 plus years in various accounting roles in public accounting, where I am now. I've worked for private companies. I've also worked for one publicly traded company. And, you know, basic accounting is pretty much the same across all of them, but each of them, each of the different types of entities have their nuances for sure. So I've seen a lot of things over the years. Today's presentation is designed to give some basic accounting best practices for your small business. Now, some of you might think the content is too basic, and some of you might see it as eye-opening. What I tried to do is structure it on kind of what me and my team see every day. We are planning a series of these presentations, and I don't know yet what the other topics are going to actually be. We've tossed around some ideas, but hopefully based on the feedback today, we can see what the audience is really looking for. So let's get started. So the first thing, I've just got like 4 or 5, kind of high level bullet points that I just kind of want to go through and hopefully just kind of get the wheels spinning. Again, some of these are gonna be like, duh, I know that I need to do this, or we're already doing this, but believe it or not, there are a lot of companies out there that don't know certain things. It's funny, we talk about it here all the time. There's a lot of great businesses out there, small businesses, large businesses, whatever. And the people that own those businesses, the people that run those businesses, they are great at doing what they do, whether it be running a restaurant, whether it be running a construction company, whether it be running a nonprofit, but they either don't understand the accounting, or they just don't want to, because they want to run their business. And so again, these are just some high level things to think about as you're doing this. The first one I just wanted to touch on is if you haven't, it's probably worthwhile to invest in some kind of accounting software. I have clients that still put everything on paper. They have if you're old enough to remember, there used to be, and there still are, 13 column green bar type things where you list all your accounts at the top, and down the side you put the dates and what they are. And we still have clients that give us stuff in that format, which it's fine, it works, but it is probably not the best way to optimize what you're trying to do in this particular digital age. So there are so many benefits to tracking in software of some kind. So I just wanted to walk through a few examples. So coming off of just doing it on paper and maybe handing that to your accountant at the end of the year to do a tax return, or maybe you do your own tax return. The first one, again, we have a lot of clients that just keep track of it in Excel. If you know Excel, it's pretty easy. You can do a lot of things in Excel. But I would say that, again, Excel's probably just a step above doing it on paper. So it's doable. We have a lot of clients that do it. Probably not the best solution. I'm going to hit these next 3 in a hurry here. So some of the more popular accounting software that's out there right now is Intuit's QuickBooks Online. And then one of them that's kind of becoming more popular is a program called Xero. And then there's also Sage 50 Accounting. So I'm not necessarily recommending anything today, but I will tell you that at the current time, QuickBooks does seem to be the most widely used in the industry. Whether you are looking to hire someone internally that can do your accounting, whether you're looking to hire someone externally that can answer questions and help you, I would just say, generally speaking, QuickBooks is going to be easier to find someone that has that experience than some of the others. There's probably hundreds of accounting softwares that you could do. And, there's industry specific softwares, construction industry specific, restaurant industry specific. But like I said, as a base point, QuickBooks is probably the most widely used and going to give you the most flexibility in finding people to help you if you are looking for that help. So yeah, so that's it with software. I'm going to move on to the next slide. I don't see any questions just yet. The next one, again, seems pretty obvious to some, but we see a lot of train wrecks every day when it comes to this, but just timely and accurate record keeping. And whether you're in an accounting software or whether you are keeping track of it on paper, the biggest thing I would say is just record everything. You have income coming in from your customers or from your donors or whatever it may be, that's going through your checking account. Record everything in some way, shape, or form. Every expense that you have, every check you write, every ACH that goes out. Let's try to get that recorded in the software or on the paper somewhere. The other thing, I had someone in my department kind of review this and they pointed it out. Yeah, include your business credit card expenses as well. Because a lot of times what we'll see is, you may have a credit card in your business and you may be charging, 50 to 100 transactions a month. And the only thing we're seeing the client record when they turn their books over to us is the payment, is the credit card payment. And so they either through a check or a direct debit to the bank, it reduces cash and it just debits a credit card expense account. But we really need to know, and you really need to know what that is. So were you spending money on the credit card for meals or fuel, or were you purchasing assets for the business? It's just really important to track all of that data the best you can. On a regular basis. A lot of clients just, again, I understand, if you're a business owner and you're kind of doing this yourself, you don't have a lot of time to deal with the accounting, but I will say the better you can become at recording everything on a regular basis. Now that doesn't have to be every day. That could be monthly, that could be weekly. You just need to get in a habit of recording everything on a regular basis for a lot of reasons. But one being, if you do a credit card charge, 6 months from now, you might not remember what it's for. 30 days from now, you're probably going to remember what it's for. So just get in some kind of a routine where, every Friday or every Monday or every other Friday, just kind of record everything and get it into whatever system you're using. Another big thing we see with a lot of small business owners is they tend to commingle their business activity and their personal activity. And that gets hard to keep track of. It just seems easy. Hey, I've got this bank account out here, my business bank account, it's got money in it. I can go ahead and go make my personal car loan payment, or I can make my house payment. But when you're going through it, trying to figure out how to do a tax return at the end of the year, then it becomes kind of an exercise to figure out what all that is. And so, when possible, keep your business separate from your personal. Probably, have two separate bank accounts. We have a lot of businesses, frankly, too, that have set up multiple entities, multiple LLCs. They might have an entity that manages the real estate. They might have another entity that manages the operations of the business. I would even say keep those separate. If you borrow money for the real estate company to buy property, I wouldn't get in the habit of paying that loan payment out of the operating company. I would be moving money around and doing it. It just makes it easier to track. And, in the off chance that you're ever audited by the IRS, they're gonna want to see that separate. Especially the personal and the business. They're not going to want to see the commingling, because then it's just going to give them reason to go dig and look for more personal expenses that maybe you shouldn't have deducted. So just a couple things to keep in mind on that. And then lastly, on the timely and accurate record keeping, monthly bank reconciliations at a minimum. We have some clients that actually, due to cash flow needs, they reconcile their bank account daily. They need to know on a daily basis what's there, and then they can project based on the accounts receivable that they know they're going to collect that week, or maybe they need to put some pressure on some of their customers. But monthly bank reconciliations at a minimum. One, just to make sure you didn't make any mistakes. Two, to make you aware if the bank has made any mistakes, because that happens from time to time as well. And then thirdly, there's a lot of bad apples out there trying to steal money, take advantage. It seems like it's pretty easy nowadays to get your hands on a routing number and a bank account number and create fictitious checks and just start passing them. And if you're not watching your account on a regular basis, I mean, you might open up a bank statement one month and find that somebody has passed some checks through your account for hundreds or even thousands of dollars. Now, in most cases, the bank will make that right. But it's just one of those things that you want to catch before it gets out of hand. I've had it happen to me, and like I said, a lot of the times the bank's going to recommend that you close the account and open a new account, and that creates a lot of headaches, because now you got to deal with a new account number, and if you're doing ACHs with a lot of places, you've got to change all of that. And so again, just the whole concept of this slide is just timely and accurate record keeping. Get everything recorded on a regular basis. Keep your business separate from your personal, and just kind of keep watching that bank account and reconciling it to make sure it's accurate as often as you can. So next slide kind of feeds into the prior slide. And what I will say on this one, hey, let's take a step back. I see we have a question. I have someone that donates to my nonprofit directly for my personal use because I don't receive a salary for the work. It's not much now. How do I manage that? Donates to my nonprofit directly for my personal use because I don't receive a salary for the work. That's, I hate to pass the buck on that. That's a tricky question, because I think we're getting into more of a tax type of a question there. But maybe Jordan can put me in touch with you and we can have that conversation offline. Yes, of course. Thank you, Jordan. So yeah, I'd like to hear some more specifics about that, and then we can talk about that. So, yeah. Okay, monthly review. Again, this ties into the last one a little bit. where I'm kind of going with this is, and this is mainly if you do have an accounting software in place, whether it be QuickBooks or Xero or whatever it might be. I think it's important to the two main financial statements that I think you're going to run as a business owner are going to be your balance sheet for one, and then I'll talk about the income statement or the profit and loss statement in a little bit. But on your balance sheet, basically with the push of if you're in an accounting software, with the push of a couple of buttons, you can generate a balance sheet and an income statement in multiple formats. Personally, to me, the balance sheet says a lot. If you can get comfortable with every number on the balance sheet, you can probably trust in general what the income statement is telling you. And so when I look at a balance sheet, I want to look at my accounts receivable and the detail that's behind that accounts receivable. So for accounts receivable, for instance, maybe you're carrying a balance of 50,000 on your balance sheet. And again, if you're using something like QuickBooks, you can run an accounts receivable aging report, and that will show you pretty quickly who still owes you money. The thing that you need to look for on there is who still owes you money. Well, not just who still owes you money, but who is late on paying you. So when you look at your accounts receivable aging report, you're going to have some things on there that are current. You're going to have greater than 30 days, greater than 60 days, greater than 90 days. Really focus on those that are getting older. Not only because the customers a couple of things could be going on. One, there could be a mistake. Maybe you accidentally billed somebody twice, and maybe that receivable isn't real. It's just great to look at that on a monthly basis and make sure you're catching those kinds of errors. But the bigger problem is it is a legitimate invoice and the customer just hasn't paid you. And the longer that goes on, the less likely it is that they're going to pay you. And so as you're looking at that, it's just a great opportunity to reach out to a customer, maybe as soon as they hit 30 days. It depends on the terms that you offer as a business, but maybe as soon as they hit 30 days, maybe you're calling them and saying, hey, we need payment, or we can't do any more work for you, or, what's going on? Do you want to set up a payment plan? Things like that. So accounts receivable is something you should be checking on a regular basis when you're looking at your balance sheet. I do have a question that says, is the balance sheet the same as a reconciliation? I'm going to say no. Generally speaking, when I was talking about the reconciliation, I was talking about like a bank account reconciliation. And usually when you run a balance sheet, you're going to have your bank account shown as the first item on your balance sheet, and then you're going to have a section for accounts receivable, and then you're going to have a section probably for fixed assets, and then maybe some other assets, and then you're going to move into a liability section, which is going to be your accounts payable, and it's going to be any loans that you have for the business. And then you're going to move into an equity section, which is essentially how much money you've put into the business. So not the same thing, but a lot of times people will talk about reconciling your balance sheet. And basically that just means going through each of these accounts and making sure each of the numbers in AR, AP, fixed assets, loan balances, making sure those, are accurate. So a lot of the things I said about accounts receivable also applies to accounts payable. The only difference is this is money you owe other people, not money that's owed to you. So again, there's several reasons for checking this, looking at the AP aging report. You might have vendors that have gotten into 60, 90, 120 days past due. There could be multiple reasons for that. One, something's been entered twice. Maybe you've negotiated something with the vendor where you don't own it or owe it anymore. Maybe it's a product that you've returned and it just didn't get handled in the accounting software right. Or maybe you're just, maybe you're having cash flow problems and you just didn't have time to pay it. And that's okay. Back when I talked about AR, when you were reaching out to your customers, there's a likelihood that your vendors are going to start reaching out to you now and wanting that payment. So that's something to keep in mind as well. Fixed assets on your balance sheet. Again, if you're using accounting software, a lot of this has to do with that. But if you're using accounting software and you're recording everything every day when you're making the entries, you can look at your balance sheet probably on a comparative basis, year over year, and you can, as you're buying equipment for your business, whether it's vehicles or a piece of equipment or a computer or whatever it is, you're going to record that as an asset on your books that you're going to track and depreciate over a certain period of time, a reasonable period of time. Again, it's just something to keep track of to make sure that you are understanding where your money is going. For fixed assets, and this might be getting a little ahead of ourselves for this particular presentation, but I would almost make a recommendation that any purchases of equipment, again, whether they be computers or whatnot, machinery, anything probably less. The IRS is going to allow you for anything less than $2,500 to just expense it directly on your tax return. So I would say as a general rule, anything less than 2,500 wouldn't fall on your balance sheet, but you can make that determination yourself, whether you want that to be 500 or 1,000 or what you want that number to be. If I go out and I buy a computer monitor and I spend $150 on it, that monitor might last me 5 years, but I don't want to necessarily keep track of that on my balance sheet for the next 5 years. It's $150. I can just run that through my income statement and be done. So just some things to think about with there. And then loan balances. Honestly, this is one of the biggest areas we see where clients are not handling this correctly. And so let's say you go borrow, again, let's go say you borrow $50,000 for a piece of equipment. And that $50,000 has an interest rate associated with it of 8%. A lot of times what we'll see our clients do, they may set the loan up correctly on their balance sheet, but when they make those loan payments, they just put the entire payment against the loan balance. And as with most loans, there is a principal and an interest component to that loan. Now, for a lot of our clients, if they bring us their books to do their tax returns, we'll ask for those year-end loan statements. So I know that, hey, this is what the bank says the balance is. Your balance is a little bit lower. There's probably an adjustment there that needs to be made for interest expense. And typically we can figure that out. But it's another one of those things that as you're doing it, if you have that statement in front of you as you're making the payments, it's something that you can do just as easily. And like I said, the mechanics of that might be something we talk about in a different presentation, but just in general, loan balances is one of those things. And so again, when I'm looking at a balance sheet, I probably should have put cash on this slide, but we talked about it on the last one. I want to be comfortable that my cash number's right. I want to be comfortable that AR is right, that AP is right, that my fixed assets are right, that my loan balances are right. And there might be a few other assets and liabilities that you have that are unique to your business. But if all of those are right, you're probably pretty accurate in what you're doing. And, it's probably, your books are probably in pretty good shape at that point. Now, I do have a question. Please comment on treatment of AR in cash basis for accrual basis taxpayers. So when you go to file your tax return as a business, one of the options is you can file as a cash basis taxpayer or an accrual basis taxpayer. So basically what that means is if I'm a cash basis taxpayer, I only report to the IRS for tax purposes money that I've collected from customers, not money that I've billed. So in that case, you wouldn't really have accounts receivable. You might bill a customer and it might take them 30 days to pay. But on a cash basis tax return, I don't have to report that income until they've paid. On an accrual basis, it gets recorded, when you bill it, when the revenue's technically earned. On the flip side, accounts payable is the same way. On a cash basis taxpayer, I may get a bill from MHCPA for doing their taxes this year, but until I pay that bill, I don't get to claim that expense on my tax return. It can sit in accounts payable on my balance sheet. I can enter it, but if I don't pay it for 4 months, so let's say let's say I bill you in October and you don't pay me until January, you don't get to deduct that in 2025. You have to wait till 2026. And so the question then becomes, well, what do I choose? If I'm a new business, I kind of get to pick. Now, there are some rules when you get to a certain level where you can't be cash basis at a certain point, but really when you're first starting out, you probably get to pick whether you want to be cash or accrual basis. I guess the biggest thing is which one's going to benefit me more? Is my accounts receivable going to be higher than my accounts payable? Are my customers going to pay me slower than I'm paying my vendors? If that's the case, then yeah, the money's going to be coming in slower. So I don't want to record revenue if I don't have the cash yet. And on the flip side, I would love to record expenses that I've got in my accounts payable before I pay them if I'm allowed to, but it's a one or the other thing. So it's just kind of a personal decision, and we can certainly help you with that if that's something you're thinking about. So any good to know info regarding items, computer, camera, etc., that were purchased before the business was officially founded, but are used 100% for the business? Sure. What I have seen and done a lot of times, and I'm making broad generalizations here with some of these answers, but what I have seen sometimes is that you can contribute those assets to the business. So for instance, if you started your business on January 1st of 2025, but in anticipation of that, you bought a computer in October that you knew you were going to use for the business, if you bought a camera that you knew you were going to use for the business, etc., you could really just kind of make an entry or keep track of that and treat that as a capital contribution. So that's one option. So in which case that would go on your balance sheet as an asset, and then it would be treated as equity that you've added to the business. The other option is you could just reimburse yourself for that. Take the expense out of the business, or write a check out of the business, and then just record it at that point as the computer or the camera or whatever it is. So that is certainly common, and we see that all the time. And so again, if it's something you need some help with, happy to help with that. So let's move on. Income statement, profit and loss. So you might hear those used interchangeably. If you're a nonprofit, you might hear statement of activity. Same with the balance sheet. If you're a nonprofit, you might hear statement of financial position. There is no 100% right name to these reports, but commonly it's going to be income statement, profit and loss, statement of activity. And same thing with the balance sheet. This is something that you should be looking at on a monthly basis. What I like to run is a couple of different reports. And again, click of a button if you're in an accounting software. If you're using Excel, or if you're doing something on paper, probably a little bit harder to get to this, but some of the ones that I like to run are a comparison of, so we just finished up March. And so maybe I would run a profit and loss for March of 2025, and then I would compare it to March of 2024. And then I would just go down the line and say, okay, what looks different, and does it make sense that it is different? You might find that you coded an expense wrong, you put it in for too much, or you might find that, yeah, my repairs and maintenance this month were double what they were a year ago. That might force you to dig into that and say, oh yeah, I remember I had to fix this plumbing problem, or I had to do whatever, and so it's good to look at that. I also like to look at a monthly report side by side with year to date. so that I can see, yeah, March was this, and for the first quarter of the year, it's this. Does that kind of make sense? Is March, typically if we're looking at 1 month versus 3 months, March should be about a third of the full year. Does that make sense? Or do I need to go back and look at something? Now, one thing I will say with a program like QuickBooks, and there are other packages out there that prohibit this, and QuickBooks does to a certain extent if you set up the security, but QuickBooks does let you post into prior periods. QuickBooks does let you delete entries that you've made. Sometimes you delete them and don't realize you did it. Not a great thing. And so again, as you're going through this, that's why it's important to kind of check everything on a regular basis. But as you're going through this, look at those monthly reports to year-to-date reports. And then, surprisingly, I don't have a lot of clients that actually have budgets set up for their businesses. And, I think a budget would be really good to set up. And a budget's just that. It's just a guide. It's just kind of an idea of where I'm going to be. If you miss budget, it's not the end of the world. But it is just an idea. And if you're a new business, it might be hard to do a budget. If you're a business that's been around for a while, you probably have some trends that, kind of work. And so if you did have a budget, that is something you could also put into an accounting software, and then you could run reports monthly to budget, year to date to budget, and things like that. So another question. How do you track if you're reinvesting funds in your LLC business versus taking a payout that month? Is it a loan from personal myself? Thanks. There's a lot of ways to do it, I guess. So, and again, this might be getting a little techie from the accounting standpoint, but so let's say for the month of March, you had net income of $20,000. How that works in the accounting flow is that by default moves into the equity section of your balance sheet as retained earnings. And so the money just stays there. So if you don't take it out, it's basically already treated as a reinvestment in the company. It adds to your tax basis. It just sits there. If you take it out, you could do it a couple of ways. When you take money out of the company, you can take it out and reduce that equity section by a distribution. And that could be a separate line item in that equity section called a distribution, just to kind of keep track of what you've taken out for the year. But if you just leave it in there, it's basically you making a contribution to the company. So there is no loan to deal with when it comes to that. Now, you could take money out. And again, some of this is getting beyond the purpose of this, but there is a thing called tax basis, where you may not have enough tax basis to take the money out like as a distribution tax free. So you might have to issue a loan to yourself. Maybe you want to borrow $10,000 from the company that month. But then that would be a loan on your balance sheet, and then you would have to pay that back at some point. So, good question though. Yeah, good question. All right, moving on to the next slide. I wasn't even going to put this in there, but the more I thought about this, I thought it just was important because it's just one of those things that everybody has to deal with. So everyone's favorite topic, payroll. So there's only really two things I want to say about this. You've got a couple of options with payroll. If you've done it yourself, especially if you did it like 10 or 15 years ago, payroll's not the funnest thing to do. So there are a lot of options out there now to outsource payroll, and that could be by hiring a firm to do it. I'm not actively trying to sell it here today, but MH does payroll. We offer flat fee, depending on the number of employees you have. Basically, in this scenario, and a lot of firms do the same, but basically you provide us the hours every week, every 2 weeks, however often you do your payroll, and then you just forget about it. We we take those hours, we issue the checks to the employees, or we ACH the direct deposit to the employees. We take care of the payroll tax payments. We take care of the quarterly tax returns. We take care of the W-2s. So it's kind of like send it in and then you don't have to worry about it. A lot of places offer that. There are a lot of softwares that offer that, and some of the softwares are getting better too. I was going to go into that. So then do it yourself is the next piece. QuickBooks, for instance, depending on the number of employees you have, QuickBooks can do your payroll for you pretty well. But it requires you to enter the hours. It requires you to make sure that you're paying your taxes. Now, QuickBooks does have some automation in it. And again, I keep repeating QuickBooks because that's the one I'm the most familiar with. But again, this could be a lot of softwares. But there is some automation where you can just tell the system, yeah, just pay the taxes. You're smart enough to know that it's tracking it correctly, so it'll just pay the taxes. There is some automation where it will automatically file the quarterly returns, and then there's some automation where it can process the W-2s as well. So there's some benefit to doing it yourself, probably a little bit of cost savings to do it yourself. But it does take a little time checking the numbers. If you're super trustworthy, you can enter the hours and just turn the automation on and let it go. But then if it's wrong for some reason, something gets changed, something gets missed, you're kind of on the hook. No one wants to get that notice from the IRS that says, hey, you didn't file your payroll tax returns on time, or you didn't pay the money in on time, and now you have a penalty. And but it's an option for a lot of people. Outsourcing is an option for a lot of people. Personally speaking, if I was running my own business, I would probably outsource it, just because I had done it back 20 years ago and hated doing payroll. But the automation wasn't there that there is today. The end of a quarter was terrible. The end of the year was terrible. It's not that way anymore. So there is a lot. It's come a long way with payroll. So then my final slide, and we've still got about 20 minutes left, but so if you have more questions, please shoot them this way and we'll answer them. But my final slide is basically, if any of what I said in the last 35, 40 minutes kind of has you scratching your head, and maybe the word balance sheet is completely foreign to you. Maybe the word income statement is completely foreign to you. Any of this, it's okay to seek professional help. There are a lot of firms out there that are set up to help small businesses to deal with all of this stuff. Now, you're going to want to find one that is a good fit for your needs. I would say typically the best case scenario is if you are a small business owner, if you could have someone entering kind of the day-to-day activity, like the accounts payable transactions, the bills, and then also entering the invoices. That's a lot of the high repetition type of stuff that maybe it's not cost beneficial to outsource that to someone. And then you could hire a firm to come in and reconcile that bank account for you, and they could print a balance sheet and an income statement for you and make sure all of those numbers tie out that we talked about, and then even sit down with you on a monthly basis or a quarterly basis and just kind of walk through it with you, and answer any questions. So again, the industry has branded this type of service as CAS, client. Let's see, what is that? Client Advisory Services, I think, or you might hear Client Accounting and Advisory Services, CAAS. And it's a really growing area of the accounting profession, because what we're finding is that the accounting talent that's out there in the marketplace is hard to find, and it's dwindling. Years and years ago, the the accounting profession put in a 150-hour rule for obtaining your CPA designation. And so, for a lot of professions, you can go to school for 4 years, get your degree, go out and start working. For public accounting, they changed that probably back 20 or 25 years ago to make it a 5-year. And so people just stopped choosing accounting as a profession. We're also in a time period right now where a lot of the baby boomers are retiring. And so there's a lot of accountants leaving the workforce there. So it is really, really hard to find quality accounting help internally. And so this niche, I guess, in the profession, if you will, of offering this service to businesses has really started to grow. And so that is something that's available. One of the benefits of outsourcing or seeking professional help is that, for the most part, if you go with someone that's fairly reputable, they can make sure that the numbers you're looking at on a monthly basis are accurate and timely. And again, I mentioned it earlier, that's one of the things we see with a lot of small businesses is the owners or the managers, they just get busy with running the business and the accounting just kind of gets put on the back burner. And it's really information that you need to know. And so outsourcing it might be a good solution. And then finally on that, the professionals can provide business insight. A lot of the people that work in our firm probably are handling 50 to 100 different clients over the course of the year, maybe more. And so we see a lot of things. We see a lot of trends. We see a lot of, margin percentages. And, so when we're looking at your income statement or your P&L, something might jump out to us that just doesn't look right with, say you're a restaurant and something just jumps out to us like, hey, payroll for your restaurant is 50% of your sales, but on most of the restaurants we deal with, it's only 30% of sales. So what's going on here? Is there anything we need to look at? And that might be something, especially if you're a new business owner, that maybe you just don't know. Maybe you don't know what that some of those percentages should look like. And so that's just some things that a professional that looks at a lot of this type of stuff every day might be able to help you with. So, okay, so it's almost 2:45. That was my last slide and the end of my prepared comments. I didn't really know how long this would go. So again, if there are any more questions, please post those on the chat. And then I will turn it back over to Jordan.
Awesome. Thank you so much, Todd. We are all caught up on questions right now, but like you said, we do still have some time left. So we'll give it a minute here and see if anyone's typing something out. I do want to reiterate too, in case a couple of you joined after I already had gone over my spiel, you will receive a recording of this. So if you would like to revisit any of the information, you will have access to. We do have a couple questions. There's one that says, is there a list or search for the CAS advisory services? What is the best way to reach out to Todd?
Okay, Jordan, I'll let you answer about how to reach out to me. Well, can I just type in the chat?
Yep, just make sure you send it to everyone. It defaults to panelists and hosts, but
To
if you do
hosts and
everyone.
panelists, to everyone. Yep. I'm just going to put my email address in here. Make sure I typed it right. Okay, so that's how you can get a hold of me. Is there a list or search for the CAS advisory services? What's the best way to, okay. I don't know that there's really a list. Like most accounting firms now are offering something similar to this. So you could look for, and actually in our firm, we actually refer to it as business advisory services, not client advisory services. But if you just do, accounting services in Champaign, Illinois, you'll probably get a list of stuff. You can kind of flip through some websites and just kind of go dig into their websites and see what they, see what they offer. One of the most important things on this is what I found is just find somebody you're comfortable with. You know, you don't need to, I mean, I'm not saying don't do this, but I recently met with a guy and we talked for probably an hour about his business and it was just all off the clock. And he's like, okay, I'm gonna go interview 5 other firms and then I'll let you know. And I'm like, well, okay, great. You know, you go do that if you want, but you know, you're probably wasting your time. Once you find somebody you're comfortable having a conversation with, somebody that you feel like you can trust, you're probably going to be okay. Maybe, maybe you want to limit it to 3, but I wouldn't just go interview everybody because again, you're going to know when you first talk to somebody, whether that's somebody you feel like you can trust. And so, but again, if you just type in accounting services in Champaign, Illinois, you're probably going to come up with a lot of stuff. So, I mean, we got a bunch of questions in a hurry there. I lost track of them. Okay, I've had the hardest time finding someone local available for simple, just to make sure things are on track. Nobody seems to be available. Any tips or checklists? So David, are you in Champaign or are you somewhere else? I assume you're in Champaign. Champaign, perfect. Well, like I said, feel free to reach out to me and you and I can have a brief conversation off the clock and see what you're looking for. And if we can help you, we will. Again, I mentioned it earlier, it's the same thing. A lot of firms out there, even a lot of companies are having a hard time finding qualified accounting people. A lot of firms are in the same boat. Um, and so, you know, there's some local firms that have lost people or closed up shop recently, and you know we're getting some of those phone calls because they don't know where else to go, and so you know we've picked up some clients that way in the last few months, and so um, our team again, Jordan, I don't think I'm supposed to be like selling ourselves during this thing. I don't know what the plan is for this, but you never told me not to, so um, but our team is about 12 people strong. Um, we have an office here in Champaign. We've got about 60 people. Some of those are tax people, some of those are audit people, but our CAS practice is about 12 people strong. We have about 7 or 8 here in Champaign. We have 1 or 2 in the Peoria office. We have a small Peoria office, and we just recently opened a small Danville office that has 1 or 2 over there as well. And so when you know, what I do hear from a lot of people is, oh, I was with this firm and the person I've dealt with for 40 years left and they don't have anybody to replace her. At least here we have a fairly large group where we can plug someone in if we need to. So anyway, that's a small sales pitch, but it wasn't intended, but you asked for it, David. So all right, Jenny, can you give me a high level explanation of what a journal entry is, what it does, and how it works? Yeah, so again, I'm gonna assume that you're using something like QuickBooks. And let's just say that you're going through your balance sheet at the end of the month and you look at your loan balance and you know it shows a balance. I'm just going to use big round numbers. It never works this way, but let's just use big round numbers. Your balance sheet shows that your loan to the bank is $49,000, but the bank is saying you owe them $50,000. Okay. So what's happened? So you've probably made a loan payment or 12 loan payments along the way where you didn't record the interest portion of that loan. And so what a journal entry would be in that case would be me going into QuickBooks, pulling up a screen that says make a journal entry. And then I would do an entry, and I'm going to get into debits and credits. And that may, you know, I don't know if everyone on here knows the difference between a debit and a credit, but I'm going to go in and I'm going to say, okay, I need to increase my loan balance by $1,000. And then I need to increase my interest expense by $1,000. The interest expense is always going to be on the income statement. The loan balance is always going to be on the balance sheet. And so I would enter that journal entry. I would date it 12/31/2024 or whatever date I want to use, whatever the bank is saying that balance should be at that date, and then I would record that journal entry. And that's how it works. Now, a lot of times, again, companies will bring us their QuickBooks file, or if they're on QuickBooks Online, we'll log into their QuickBooks file for them. And then when we go to do the tax return, we will send a list of journal entries back to the client. We'll find a few errors here and there, a few things that just didn't look right to us. One of them is property taxes, ironically, that we adjust a lot. But we'll find these entries and we will prepare them for the client, and then we'll either make them in their QuickBooks for them or send them back to them. Just, again, basically just trying to get the balance sheet right and making sure everything is the way it's supposed to be before we file that tax return for them. So what do you think of using QuickBooks invoicing compared to others? I think it depends on the industry. A lot of people use QuickBooks invoicing. Now, when you say compared to others, I don't know if you're referring to Xero and Sage 50. I am not that familiar with those. I will say that if you are in a certain type of industry, there's probably better invoicing packages out there with industry specific packages or industry specific add-ons. That's something we didn't talk about either. QuickBooks is what it is, but if you are a manufacturer, there are some third-party add-ons that you can subscribe to, where you do a lot of the invoicing and a lot of the inventory tracking in the third party, and then it creates an entry into QuickBooks once a day, once a month, or whatever. So I think QuickBooks invoicing is okay. It really probably just depends on the industry and what you're trying to track. I did read something the other day that there's some new software coming out for law firms because QuickBooks is not. And again, I don't know this, I'm just reading this, but a lot of law firms are not happy with the invoicing functionality just because they have a lot of different things that they do where they're holding clients' money and they're not, so there's again, I would just say it's probably industry specific, but happy to talk specifics about that with you if you want. All right. Thank you for hosting today. Learn more about MHCPA. Awesome. Thanks, Jordan.
Yeah, no problem. And yeah, definitely always happy to discuss your guys' services that you offer. At the SBDC too, we do keep a list of professionals in all different fields, marketing, accounting, legal services, and things like that. So if anyone is an SBDC client and looking for a reference to someone in one of those industries, we can always provide those too for, ones here in our community and that have local presence. So thank you. Thank you to everyone for joining us today. We did have a pretty big group who joined, so we appreciate you spending some time with us. I do want to mention real quick, if any of you are here as a part of the City of Champaign grant program, if you could send me a quick email or respond to the follow-up email I send tomorrow, we'll make sure that we get you tracked as attending this session for your grant. So I do want to make sure we get all of that done. But it looks like we're all caught up. As a reminder, that follow-up email will go out to tomorrow, and I can include Todd, your contact information if you're okay with that in the follow-up email, in case anyone has some questions or wants to connect with you and explore things further and what MH can offer.
Okay.
All right. Well, we'll go ahead and close out today's session. Thank you, everyone, for joining us, and thank you so much, Todd, for presenting.
You bet. Thank you. Thanks, everyone.
Have a great day. Bye-bye.